Ladies and gentlemen, please welcome the Managing Director of Guggenheim Securities, Jake Fuller.
Join me in welcoming Mark Mahaney, Managing Director, RBC Capital Markets, Rachael Rothman, Analyst, Susquehanna Financial Group, Eric Sheridan, Managing Director, UBS, and Lloyd Walmsley, Director, Deutsche Bank Securities. Thank you. All right, so we have a bunch of Wall Street people up here, and I guess the first question we're going to have to dive right into is the obvious one. Since the third quarter earnings results, Expedia, Priceline, TripAdvisor, Trivago have lost about $20 billion in market capitalization. What the heck do you think's going on? And Mark, let me start with you.
I think there's at least, how about four things? So first, there may be maturity in the sector. This is the internet category that's most penetrated online. Growth rates do slow down over time. Investors always get a little spooked when you get a slowdown in the growth rate. Secondly, there's this major debate over what the best marketing channels should be, and looks like there's a real pullback from some of these meta search channels like TripAdvisor and Trivago. Third, you had a lot of little one-time events. You know, hurricanes do impact travel. Obviously, there's one-time events like that. And then fourth, and Rachael and I were talking about this, and she knows this a lot better than I do, but we've seen it in our survey data too. I think there's a little pullback from the OTAs and a little bit of a shift, at least in the US market, towards the hotel channel. All of that's conspired to make people concerned about the growth rate and the profitability of the OTAs, more so than 3 months ago.
Eric, any perspective?
Yeah, I think it is that uncertainty. I think, you know, as I talk to investors coming out of these earnings reports, I think that line of sight on growth, you know, are these 10% growth companies, 15%, 20%, and what is the cost of that growth? You know, if it's going to be a slowing growth environment with a compressing margin environment, people will pay a lower multiple for these stocks. And I think that's the key investor debate that's front of mind right now.
So what's the answer? Are they 10 or are they 20?
I think it's closer to 20 than 10. As you look out, I do think, as Mark highlighted, I think there are some idiosyncratic things, tough comparisons in year-on-year growth rates, some shifts in marketing dollars that are pushing shorter duration return dollars into longer duration return dollars. I think those are all good long-term decisions, but they're dampening some of the short-term growth rates.
Yeah, and Lloyd, anything to add on that?
Yeah, I would agree with what these guys have said and add to that. Look, we have new management teams running both companies, and one of the things, particularly at Priceline, that investors have loved about that company over the last 10 years has just been the remarkable, consistent execution. They have a great playbook. They're the best at running the playbook, and it's simple to understand. And so when you start to see new management come in, changing the strategy around, I think it unnerves investors who are used to and like that stability. But ultimately, you know, I think the decisions being made are probably the right ones, and you know, I think there's still plenty of room for the industry to grow going forward.
So I want to look at this from another angle as well, because for the first time this year we have a hotel analyst with us. Hotel stocks are doing just fine in all of this, right? We've seen this massive destruction in online travel value. What's going on the hotel side? Can we rule out the idea that there's some sort of end market problem, that hotel demand has kind of fallen apart?
So I guess a couple things. Thank you for inviting me, and not to be the black sheep of the family, because I'm honored to be up here with you guys. But to Mark's point earlier, I think we know from the industry-wide data put out by Calibri that there is a definite shift to book direct, or something like Hilton's Stop Clicking Around campaign, and that is in fact working. I would also just highlight that, you know, going back 30 years from hotel school, we always thought of the brands as occupancy insurance. And now that we're getting 92 months into the recovery, I think you are going to see that brand power start to come back into effect. And you've seen some of the hotel owners that have moved away from branded product to independent, that relied on things like Expedia and Priceline, actually suffer and underperform. And so I think it's being proven out to the owners and to the operators that the brands actually are working and that scale is working. Occupancies are at all-time highs in the hotel industry. My stocks are at all-time highs, and there is no sign that it is because of waning demand. True, there's not a ton of pricing power, but it isn't a demand issue.
Interesting.
And what's your answer to the question?
Hey, yeah, so I think it's much like you said, right? The industry is beginning to age, and investors had a certain expectation that growth is just always going to be what it was last quarter. And the reality is, penetration has progressed. There is still a big secular opportunity. It's just not going to grow at 20% forever, right? We have to recalibrate our, expectations to something a little bit lower. And when yesterday Glenn Fogel and Steve Kaufer were asked the question about what's happening in the stocks, they sort of brushed it off. Are they right, or is the market overshooting on all of this? And Eric, let me turn to you.
I think for what I've seen in the last couple of weeks, it does seem like a little bit of overshooting. I think you injected the word earlier, and so did Lloyd, around uncertainty. I mean, when investors see uncertainty, they pay lower prices because they don't have good line of sight on forward trends. Are they linear? Are they volatile? I think that's what we're seeing. It was a well-owned group. To your point earlier, it was a group that you could count on a certain cadence of operating performance, quarter in and quarter out. You've seen management changes, but I think people have shot first, and they're going to ask some questions later in terms of the stock performance.
And what do you think it takes to revive that investor interest, Mark? What do they have to show us?
So I completely agree with Eric. I think the stocks have overshot. I think Priceline and Expedia, and we've been covering these stocks, forever. I think they're extremely good assets, extremely well positioned, particularly Priceline in international markets. I'm just struck by the fact that Priceline has a larger base of hotel room nights, and they still grow faster than Expedia, even though they have tougher comps. It says something about just how well positioned they are geographically. In terms of categories, in terms of markets, et cetera, really fragmented markets, especially if you leave the US where the chains are really weak. I think these are generally buying opportunities when you see double-digit declines in these stocks. So what is it going to take to get investors back? Probably a couple of quarters, and you got to see if those growth rates really are more like 10 or more like 20. Just keep in mind, I think these are almost like internet utilities, or we refer to consumer staples, they're internet staples. You shouldn't just think FANG, Facebook, Amazon, Netflix, Google. You should think PE FANG, Priceline and Expedia. They're very good assets. Occasionally when they get wobbly, that's when you make money buying the stocks. I don't think that the long-term growth prospects for these companies have changed nearly as much as the stocks imply.
So we could probably spend the entire session talking about the stocks, but I do want to make sure we hit on some other evolving themes in the space. And in particular, I want to touch on what seems to be a change in how the online travel guys are advertising. So we've seen and heard Priceline pulling back a little bit on Meta. And it really brings me back a couple of years. I don't know how many of you were at the conference when former Priceline chairman Jeff Boyd talked about the fictitious dogpile.com in reference to metasearch and a rant against metasearch. Are we back to the dogpile days? What's going on here with the OTAs pulling back spend on metasearch? Lloyd, any perspective?
Yeah, I think you have to look at each situation individually, and obviously, Priceline has been the most vocal about pulling back. And they had spent a lot of money on Trivago over the last 2 years, and I think Trivago was pushing pretty hard, and you have a new management team come in and decide to take the strategy a little bit more aggressively, and they had been funding a competitor in search channels, so I think it makes eminent sense to kind of try to reset that auction. Priceline has spent some money in TV historically, but Booking.com's brand and in all of our survey work has still lagged that of peers, so I think it makes sense to be building a brand, and particularly, we'll have to see what Oliver has to say from Google, but I think Google is going to continue to move further and further into the travel vertical, and that poses obvious risks if you don't have a strong brand. So I think it makes sense to refocus there. Our view is that ultimately, after a few quarters, we wouldn't be surprised to see the big OTAs come back more aggressively into Meta. Ultimately, they want to grow at scale, and that requires acquiring traffic. And I think they can come back in with a reset auction, and and come out better after taking a pause.
And Rachael, one of the things I've seen over the years is the hotel chains have been relatively slow to embrace the online advertising channels, whether that be Google paid search or TripAdvisor or Trivago. Is there a reason they haven't gone after that more aggressively, and could they be someone that steps in to fill the gap we're seeing now if Priceline is pulling back?
I guess my answer is that they're unlikely to step in to fill that gap. I think that historically has not necessarily been a customer that they wanted. I view it as somebody that's pretty brand agnostic and very price sensitive. I think what you could see, though, would be some of the bigger brands stepping in through something like an Instagram or a Facebook and saying, like, hey, Rachel, I see you're celebrating your 10-year wedding anniversary at the Ritz-Carlton Naples, June 13th. How about you go next year to the Ritz-Carlton Dana Point and you book today and we'll give you 20% off. Yeah. They already know that I'm a loyal Ritz-Carlton customer. They can see that I'm taking photos and interacting and putting that messaging out there, and they can go direct to the customer with a targeted offer that they know they're likely to accept. That's ad dollars well spent.
Interesting. So the other side of this is we're talking about TV now, which is very interesting to me. I think we've seen everybody from Grubhub and Yelp and TripAdvisor and now Priceline all of a sudden putting dollars into TV. Eric, what's changed? What are they hoping to get out of this?
Well, I think at the end of the day, they're trying to drive as much direct traffic as possible. I mean, whether it be Google or the meta search companies, at the end of the day, that is a cost of acquisition that if you can get someone to come direct to app, direct to site, and then more importantly, come back direct a second or third time, your lifetime value of that customer is escalating. And I think there's still big questions of whether getting more direct traffic will change the ROI on marketing dollars long term. I think that's one that's uncertain, but they feel probably more likely than not. Hence, let's see if we can develop a more direct relationship with our customers. I think you'll see Instagram and Facebook as channels that are used in that manner. I think you'll see TV. I think you'll see mobile app download ads. I think you'll see a lot of different mechanisms by which they can try to engage more directly with customers.
And Mark, it seems like the world everywhere else has gone the other way, right? We see Google's growth and Facebook's growth every quarter. Why, is the traditional consumer world moving dollars into online and the internet world moving dollars into TV? Is there something we're missing here?
I think at the end of the day, you're still going to find the majority of their ad dollars are still going to be online. I mean, I think with Priceline, I can't do the numbers off the top of my head, but it's going to be 2/3 or 3/4 or something like that of all their ad spend is still going to be online. So I think they're just toggling a little bit. And in part because they, there's a little bit of them being pissed off with what some of the vertical meta search players were doing and trying to go and competing with them directly. But there'll be a little bit of a shift back. I guess if you really want to scale the business, you kind of have to advertise on TV at some point. It is the largest advertising. No, it's the second largest advertising medium for a reason. So if you've figured out and optimized your online strategy, you have to have an offline one. I don't know why you wouldn't consider TV. So I don't see it as a seismic shift. And maybe it's a sign of just how big the industry is, that you've got to continue to grow. You got to start using these things called offline.
Yeah. The other benefit I would just add to this TV spend is it makes the online spend more efficient. So Google obviously has a quality score, and the higher your click-through rate is, the lower you pay for ads. And Kayak, when they were public, gave us enough disclosure as part of the IPO process and being public that we could see when they started ramping their TV spend in the first 2 years after they ramped their TV spend, the cost that they had to pay for their digitally acquired clicks was cut in half. And so, I wouldn't expect the same magnitude for a brand as big as Booking.com, but there are secondary benefits to being on TV.
So to shift gears a little bit, one of the big themes yesterday was certainly alternative accommodations. Seems to be going mainstream fast, and it looks to me like the financial press wants to lay a lot of the blame for the OTA value destruction on the doorstep of Airbnb. Do you guys have a perspective that that's a part of the big sell-off? Are they finally feeling the pinch? Let me start with you, Mark.
Probably. I think Airbnb, I'm actually curious, how many people here staying at the conference are not staying in a hotel or staying in an alternative accommodation, not staying in a hotel? And it looks like about 18% from what I just calculated there.
18.5?
18.5 maybe. And, look, I think there's no question that this is a dramatic shift, and, this is a huge implications for Rachel's, and hotel stocks. And I don't know if it's good or bad. I have an uninformed opinion about whether it's good or bad for them. But it's a clear growth category. It should be a great opportunity for the online travel agencies, and it's a wonderful opportunity for the company that really spearheaded this market opportunity, Airbnb. Anybody who's retailing products, which is what these OTAs are, and you're retailing a really fragmented supplier base like alternative accommodations, that means you get good economics. So it's probably had a little bit of a headwind in their growth, but it's a great long-term opportunity if they can figure out how to get all that inventory, put it in the same kind of search funnel on the site, so that that person going to Orlando, that Priceline and Expedia and any other OTA can figure out whether to make that the Disney resort, that bungalow, or a traditional hotel. It should be good for demand for companies that are really good at analytics and improving conversion rates. There should be a great opportunity for them.
And Rachel, interesting for you too, it's not just Airbnb, but it's also the big OTAs are pushing very aggressively into vacation rental. Is there any evidence yet that we can point to that this is beginning to impact the hotel industry or not?
I guess I would say two things. First, there is some thought that it takes away pricing power on compression nights. So that would be if you had South by Southwest in Austin, Texas, for example. Historically, maybe you could have raised your room rate by 30%. Now you can only raise it by 10. But we also have to consider that Airbnb supply is flexible, meaning people put their capacity on when the rates are the highest. And I personally am of the belief that Hilton and Marriott and their owners' balance sheets are built for a recession. When we go into a recession, the Airbnb owners, those people, many of them have extended themselves into having multiple properties. And when they find that they can only rent that home for $30 and it's either $100 or 5 of their own hard labor hours to clean it, you're going to see a lot of that capacity come off the market. And I think it's going to be the same sort of balance sheet lesson that a lot of individual homeowners learned in the 2008 recession. So I don't think it's game ending for the lodging industry in any way.
So we talk about lodging, we think about hotel chains, but the hotel chains have actually spun off their timeshare businesses. Yeah. So you now have a group of standalone public companies in that sphere. And it would seem to me that they're much more directly in the crosshairs of Airbnb, of the vacation rental. How do you think about the impact there? Is it something different?
Well, timeshare, firstly, there's a huge shift in the US, as we know, moving from buying things to buying experiences, right? When I was cool, you needed the Nike Air Jordans. My kids don't give a hoot what they're wearing. They want to be, in the picture on the cruise ship or wherever doing something cool. So number one, the timeshare companies are doing really, really well because it's essentially pre-funding a lifetime of memories and experiences. That's what these sales efforts are selling. They're not selling a week in Orlando or a week at Opryland. They're saying, give us $3,000 and $75 a month for the next 15 years, and you and your family can go on a week-long vacation for the rest of your lives. Invest in experiences and time and memories with your kids. Pay us now, and it's working.
So I want to shift gears a little bit here. There's always been sort of a natural tension between the online travel industry and the hotel industry. Last year we really had the birth of the loyalty discounts, and it was a big theme, a big concern across the landscape. Eric, how do you think that's progressed? Has that progressed as a big threat to the OTAs? Is maybe that part of what we're seeing now?
Well, it was interesting. Phocuswright yesterday put up a lot of their own data saying that loyalty rewards don't actually drive as much velocity of shopping in travel. We've done consumer intention surveys that say similar things. The business market seems like it's much more driven by loyalty and rewards than the consumer marketplace. So I think there's a dynamic there that we have to address. But I would expect over time that the OTAs, maybe even an Airbnb, explore loyalty and reward programs over time. I mean, you do want to create experiences where people want to come back and associate with brands. And I would expect it to become part of the narrative to a greater degree over the next 5-10 years.
Yeah, Lloyd?
Yeah, look, I think it makes sense for the hotels to try to do this, and from the data, from the likes of Calibri Labs and Phocuswright, it's having some marginal impact, it seems, but it does irk the owners. I mean, they're underwriting a lot of this loyalty expense. I was talking to one last night, not very pleased about the loyalty pricing and funding all of this. But I think it is here to stay, and it will probably help the hotels with a bit of their direct business. But ultimately, Expedia has a great loyalty program of their own. I think it's probably not going to be as meaningful as other levers of change and growth
Yep.
for the businesses.
And Rachel, does that sort of jive with what you were saying earlier? I mean, it sounds like from our side, we're all kind of saying, not that big of a deal. And from your side, it's working.
I think it's working. I think it is a big deal, and I think it's going to become a bigger deal because, and I know nothing about Expedia or any of these guys, so take that with a grain of salt. But Expedia may be able to offer you a free flight or a free whatever hotel stay at XYZ resort. What they can't offer you is 9 a.m. checkout, check-in, 4 p.m. checkout, free breakfast, unlimited free cocktails, free pole position at the swimming pool, any sort of amenity that one of these hotel owners or operators can offer to their customers.
So that's a very interesting point because one of the things we heard yesterday was, I think it was Steve Hefner, who talked about, well, he sees Priceline maybe buying hotel assets, floors or whole hotels. Mark, what do you think about that? How would the market react if we saw Priceline buying up hotels or hotel chains?
Freak out. That's a
He did say it.
business.
Yeah,
right?
what you technically said was freak out, and I agree. I think the market would freak out if they saw that.
Yeah.
That kind of undermines the value proposition. And I don't know that they need to. Again, the supply market is so freaking fragmented. There's 1 million hotel properties, something like that. I've always heard that number. I don't know if it's true worldwide. It's something close to that number. But then you layer in alternative accommodations. I mean, there are millions of options. So if you're going to Fort Lauderdale or where are we, Hollywood? The number of lodging options. That's great for these intermediaries. So why they would need to buy physical assets? What they need to do is build their brands. I mean, there's one company. There's very few names where you could say, hey, this weekend I stayed at an Airbnb down in Fort Lauderdale. That means something for most people. Saying I stayed at a Westin, come in Monday morning and say, hey, I just stayed at a Westin this last weekend in Fort Lauderdale. It doesn't mean much for most people. There's a few hotel names that really have that cachet, and what Priceline and Expedia are trying to do is build up that cachet. Airbnb luckily and through skill got that. Other people need to get that in order to win.
So I'm aiming a little bit here at trying to go down the talking about consolidation route, right? Or just new entrants into the space in general. One of the other things I heard yesterday was Brad Gerstner talk about it being inconceivable to him that Amazon wouldn't be back in the travel at some point. But it brings to mind a broader point. What about Amazon, Facebook, Google? Where do you guys see them progressing over the next couple of years in the travel vertical?
Jake, to your point, I mean, Amazon's tried a couple times at this in more beta mode and never really gotten much further than that. I mean, to Mark's point earlier, I think the inventory is so fragmented on a global scale that in order to achieve scale, I think it would take quite a long time to achieve the scale benefits that Expedia and Priceline have on the inventory side. Not saying Amazon wouldn't try. I certainly would never bet against Amazon being disruptive. That tends to be a pretty bad bet over time to make. Google, we've always been fairly dismissive of the concept that Google's going to become an OTA, as we've talked to people in the industry. Yeah. Google wants more of their partners' marketing budgets by delivering more qualified leads and getting higher CPCs from it. So in our view, Google's always wanted to own more of the top of the funnel than the actual bottom part of the funnel. But the popular press and a lot of industry people continue to want to point to Google as a potential OTA long term. Yeah. I would downplay that possibility.
Lloyd?
Yeah, look, I mean, I think Amazon has tried and backed away from the travel space 3 or 4 times. And it's a hard space, as Eric said, and you just look at what Expedia is spending on technology to try to catch up to Booking.com. It's over $1 billion a year. It's really expensive to compete on a global basis, and it is a global business. As far as Google, yeah, look, I think they are trying to walk that fine line of making, as I think in the words of someone I just spoke to, trying to make as much money out of their black box as they can. Without having to go out and hire 10,000 people to run customer support and supply acquisition, but they're in a great position for a number of reasons. Obviously, almost every business in the world knows they need at least a presence on Google, many of which have a paying relationship with Google on the advertising side. Consumers start much of their activity on Google, and so they're in a good position to further move down the funnel. And then the other huge advantage they have is just data. I mean, they've got immense data through all of their apps, Chrome, Google Maps, Gmail. Yeah. What they've done with the Trips app is amazing. And as we move to a world with voice interaction layers, assistants, and AI, they're in the position to serve more and more of your travel needs and ultimately take a bigger chunk of the economics.
Now, I think we could keep going on for hours and hours, but we are out of time. So I want to thank you all for joining me. Mark, Rachel, Eric, and Lloyd. Thank you.
Thank you.
Kayak is a global tech company focused on making the online travel experience better. When people are searching for travel, if the site is really slow, they're going to go somewhere else. So for us, it's really, really important to get the results back to the user as quickly as possible. We need to have a content delivery network like Fastly to make sure that the content still gets there as quickly as possible. Fastly has a gigantic cache for a lot of static content, hotel images, JavaScript, CSS, stuff like that. That makes the experience for the user much faster to get that data.